Debits and credits are the heart and soul of accounting, but many people get confused by how they work. So today, I'm gonna fix that. I'll teach you how to understand debits and credits by covering 4 core topics so that when we're done, you'll understand the exact debit and credit to record under any scenario. Starting with our first topic, what are debits and credits? Well, they aren't really anything. Debits and credits are just a way to communicate how the values on your general ledger are either increasing or decreasing. So anytime something happens financially in a business, you'd say debit this or credit that. Now, if you want, you can instead say increase this account and decrease that account, but then you won't really sound like a cool accountant. See, debits and credits are the way in which you communicate what's happening with double entry accounting. Here, let's back up and discuss what double entry accounting is. But before I do, we need to discuss topic number 2, the accounting equation. The accounting equation states that assets equals liabilities plus owner's equity. Assets are items of economic value that the business owns or substantially controls. Liabilities are amounts that the business owes to creditors, while owner's equity is amounts that the business owes to owners. So the accounting equation really just shows you that everything the business owns is owed to either a creditor or an owner. Simple, right? Well, this must always balance. It's impossible for the business to own an asset that is not owed to either a creditor or an owner of the business. Or another way to look at it, if you take your assets and subtract out your liabilities, you'll get the net worth of the business or how much the owners can claim. And as we'll soon see, just like assets must always equal liabilities plus owner's equity, debits must always equal credits. And that's what brings us to our third topic, double entry accounting. This means that any financial event that takes place in a business has 2 sides, which will impact the accounting equation. And you communicate the impact of those 2 sides with a debit and a credit. So before we explain debits and credits, let me show you how double entry accounting works with a few examples. Example number 1, let's say you take out a loan for $50,000. You have money. Money is an asset, but you owe that money to a creditor, which is a liability. That means your assets go up by $50,000 and your liabilities go up by $50,000. Assets equals liabilities plus owner's equity. Example number 2, let's say a customer owes you $1,000 and they pay you. Amounts owed from customers are called accounts receivable, which is an asset since it's an item of economic value. So when a customer pays you, your cash, which is also an asset, will go up, and your accounts receivable, which is another asset, will go down. Assets cancel out to 0, liabilities and owner's equity are unaffected. They remain at 0 too. So assets again equals liabilities plus owner's equity. Let's go through one last example. Maybe you invested $100,000 into a business. Well, from the business's perspective, there's now $100,000 in cash, which is an asset. But now the business owes $100,000 to the owners of the business. If the business liquidates tomorrow, it's going to pay back that $100,000 to the owners. And because this $100,000 is an amount owed to the owner, it's an owner's equity account. Assets go up by $100,000, liabilities are unaffected, owner's equity goes up by $100,000. Once again, assets equals liabilities plus owner's equity. So to recap on these 3 concepts, number 1, debits and credits are the way that you just showcase which accounts in your financial statements are increasing or decreasing. And you communicate that by recording both a debit and a credit. Debits must always equal credits, and different accounts have different rules for whether a debit or a credit means increase or decrease. Number 2, the accounting equation states that assets equals liabilities plus owner's equity, which means that all items of economic value that the business owns or substantially controls is owed to either the creditors of the business or the owners of the business. And then number 3, double entry accounting. This means that every financial event has 2 sides to it, which will affect this equation by a debit and a credit. All right, so we got the foundation out of the way. Now we're ready to go deep. Actually, I lied. Oops. Okay, there's one more concept that I want to explain, but I promise it is just as easy as these 3 other concepts. So far, we've only been talking about the accounting equation. This correlates with the sections in what's known as a balance sheet, which is a financial statement that shows the snapshot in time of a company's financial position. There's also another financial statement called the profit and loss, which shows you the details behind your income in your business and your expenses. All that income gets netted out into an account called net income. So what are the income accounts in a profit and loss? Well, anything that shows under revenue or other income. What are the expense accounts on a profit and loss? Anything that shows under cost of goods sold, operating expenses, or other expenses. When you net these together, you get net income. But here's the key. The profit and loss and balance sheet are connected. This net income amount, it pushes its value to the balance sheet under an owner's equity account called retained earnings. Think about it. If the business generates a positive net income in a period, that means cash or another asset like accounts receivable enters the business and the owners now have a claim on that asset. And because the balance sheet shows cumulative values, your retained earnings will showcase the cumulative value of all the profits you haven't paid out yet to the owners. So remember before when I said that every financial event affects the accounting equation? Well, that's still true because any income or expense activity will bring up or down your owner's equity balance, which gets displayed in your balance sheet. If you generate a positive net income, your owner's equity value goes up. If you generate a net loss, your owner's equity value goes down. All right, as promised, now that we understand these 4 concepts, understanding debits and credits will be a breeze. You just need to memorize this one thing. Are you ready? Assets go up with a debit and down with a credit. Did you catch that? That is all you need to memorize. Assets go up with a debit and down with a credit. If you memorize that, you'll know that because assets go up with a debit and down with a credit, that means that any liability or owner's equity behaves in the exact opposite manner, since they are on the opposite side of the accounting equation. So any liability or owner's equity account goes up with a credit and down with a debit, the opposite of an asset. But remember, your profit and loss gets netted out into your owner's equity account. That means that all income accounts, which make up your equity, go up with a credit and go down with a debit, just like owner's equity behaves. And all of your expense accounts will operate in the opposite manner. Because they bring your owner's equity account down, the more expenses you have, the less you have in net income, the lower your owner's equity. That means expenses will get debited, they go up with a debit and down with a credit. Okay, that's a lot that I just threw at you. Let's revisit these 3 examples, this time working through what debits and credits are. So for example number 1, you took out a loan for $50,000. You have $50,000 in cash. Cash is an asset. How do you show an asset increasing? With a debit. Debit cash for $50,000. You now owe $50,000 to a creditor. Amounts owed to creditors are called liabilities. Liabilities go up in the opposite manner as assets do with debits and credits. So do you debit or credit this liability account now for $50,000? That's right, you credit it. Debit cash for $50,000, credit accounts payable for $50,000. Example number 2, a customer pays you $1,000 that they previously owed you. You now have $1,000 in cash. Cash is an asset. How do assets go up? That's right, with a debit. And amounts that customers owe you are called accounts receivable, which is another asset. Because that asset went down when the customer paid you, how do we show an asset going down? Correct, with a credit. Debit cash for $1,000, credit accounts receivable for $1,000. For example number 3, let's change it up. Let's say instead of investing $100,000 in a business, you instead made $100,000 worth of sales. Sales is a profit and loss account, which we call revenue. Revenue makes our owner's equity go up. So will revenue going up by $100,000 be recorded with a debit or a credit? Remember, owner's equity behaves in the opposite manner that assets behaves. It goes up with a credit. So we credit revenue by $100,000, which is another way of saying our owner's equity is going up by $100,000. Then we also receive cash. Cash is an asset. How do assets go up? With a debit. So we debit cash for $100,000 and we credit revenue for $100,000. Okay, let's go over a bonus example for number 4. Let's say we incur a rent expense of $5,000 and we agree to pay it in the next month. Well, rent is an expense that gets shown on our P&L. Expenses make our owner's equity account on the balance sheet go down. So if an expense goes up and owner's equity goes down, how do we show that? With a debit or a credit? With a debit. And when we agree to pay someone something, that's a liability. When a liability goes up, how do we show that? With a credit. Debit rent expense for $5,000 and credit accounts payable for $5,000. But if you're just now learning debits and credits, you need to understand the intricacies of how the financial statements work and how they're connected. And this video over here will walk you through all of that. And I'll catch you in the next video.